Good morning, everyone, and welcome to our TREC webinar. We are very grateful to have Jimmy Hinton with us here today. For the moment, we're going to take a few seconds to let everyone get signed on, and in the meantime, please take a moment to review our slides sharing how you can ask questions. We'll take questions at the end of the presentation, and then we'll be back with you in just a moment. All right, thank you again for joining us for our TREC webinar. Now I'd like to introduce our presenter this morning, Jimmy Hinton of HFF. Jimmy is Managing Director of HFF. He is responsible for the firm's national research efforts. He works with the executive management team to assist in investor relations and inform both HFF staff and firm clients with in-depth analysis of economic, property, and capital market trends. He has, in particular, been a great friend to TREC and shares his insights with us. So we're excited to have him here this morning. And with that, I'll turn it over to you, Jimmy.
Thanks very much. Good morning, everybody. About a month ago, I visited Dallas and presented all of HFF's thoughts about the merits of investing in the Dallas-Fort Worth Metroplex area as a real estate investor, and we wanted to provide this presentation to a broader audience. So I'm going to move through over the next half hour all the capital markets trends that are impacting the Dallas real estate market and the Fort Worth real estate market over the past couple of years to the good. Talk about some of the concerns that investors share with us as they think about investing late cycle, and how a market like Dallas-Fort Worth can help somebody really form a more defensive real estate portfolio. Before I get into the meat of the presentation, I really wanted to try to give you the conclusions that we have before we get into all the details that go into making those conclusions. As we entered the second half of 2017, obviously now we're in the fourth quarter, we were thinking about the country and the rest of the world and what may come to pass. The labor market at the end of June was, and really before the end of June, was what we would call fully employed, meaning that the unemployment rate was well below everyone's target, that the number of qualified employees available to corporations for open positions was really starting to dwindle. And that would be worrisome if we didn't have a labor participation rate that was improving, but we do. We are seeing people that have been out of the workforce come back into the workforce and increase the labor participation rate. And that's really important, because if we want to continue to see job growth, not only in the Dallas-Fort Worth area, but the rest of the country, then we need to have people who are able to be employed. So we continue to see a rising participation rate, which is great. Meanwhile, wage growth remains positive, but it's not getting overheated. We think about a wage growth target of 4% being the threshold where corporations start to see adding new employees is too expensive and they stop hiring, and as the asset class that houses corporations in the broader economy, we definitely want them to continue hiring. So a rising participation rate and positive but not overheated wage growth is really, really good for our industry. The next bullet point here, reflation concern has eased, is a little bit dated. So this was, again, going into the second half of the year. In the immediate aftermath of the presidential election, we saw the yield on the 10-year Treasury rise 100 basis points. And many investors were talking to us about rising interest rates, what impact that would have on asset valuations, what impact it would have on cap rates, what impact it would have on cost of capital, et cetera. And the word reflation started to come up in many conversations. Now, I'm just a finance major, so I had to look up what reflation meant. And reflation is an environment where you have interest rates that are rising faster than NOI growth, which is very destructive to asset valuations in real estate. Through the first half of the year, that reflation concern eased because we saw that 100 basis point rise in the 10-year Treasury back down. Since June, we've seen interest rates rise again. So reflation is starting to come back into the conversation amongst HFF staff and the investors that we work with. So it's something we're keeping an eye on. Because as people are coming into a late part of the cycle, they're very focused on NOI growth should interest rates continue to rise. Political risk has really abated. We saw some political volatility early in the year when South Korea, which is a very large economy and a huge source of capital for U.S. real estate, not only the country, but Dallas in particular. South Korea impeached their president, elected a new one. We saw some pretty uneventful election results in France, and Germany just finished their elections. And while Merkel lost a majority, she retained her title. So capital risk has really abated, and the type of political risk that we're talking about now at HFF has more to do with domestic fiscal policy, domestic monetary policy, and very important is the tax cuts that are currently on the table in Washington, D.C. So those are all exogenous risks that we think about impacting the real estate market. In terms of risks that are inside the real estate market, we talk about availability of capital. We talk about additions of new supply to an existing marketplace, and we talk about asset pricing. What I'm going to show you through this presentation is that capital is widely available, both in the debt side of the market and in the equity side of the market, and that there is a very diverse market of participants both in debt and equity. But what I'm going to tell you is that that capital is not desperate. It's not going to deploy for the sake of deployment. It's going to be very thoughtful about how it underwrites and places risk in its portfolio. Development remains very difficult, and as a person that works at a transaction firm, development is great because not only are we able to capitalize the developments, but when those developments stabilize, we can recapitalize that stable development with a permanent loan or sell it to an investor. So you would think that development remaining difficult would be something that I don't like. At this stage in the cycle, I do enjoy it because development at times can add volatility to a marketplace. We'll talk about that later. But there's two reasons why we see development being muted going forward. Not only is there a barrier in the terms of higher development costs, another barrier would be the lack of broad availability of construction financing from traditional lenders. Lastly, what we see moving into this last quarter of the year is that asset pricing will continue to be determined by the way that investors see property fundamentals going forward. Asset pricing is not going to be dictated by people's ability to financially engineer their way into an IRR. And in an environment where we don't see cost of capital continuing to decrease, after many years of that environment, people are hyper-focused on asset performance and market performance, which again bodes well for Dallas, Texas. So what I want to breeze through here quickly, because we have a shorter amount of time than normal today, is a big tailwind that's been helping the real estate industry for the past several years, and that is the performance of real estate versus other asset classes like stocks and bonds and commodities and treasuries. If I go back 1 year, 5 years, 10 years, or 15 years, real estate is always very competitive on a return standpoint versus these other asset classes. Now, the past year for the stock market has been, to use the scientific term, bananas. And so on a 1 year basis, it's been very difficult for real estate to outperform stocks. And, these metrics are as of June. And what some of you may know is that the stock market just broke through 23,000. The Dow Jones broke through 23,000 yesterday. So on a 1 year basis, I would expect 17.9 to go even higher if I were calculating this through the end of the quarter. And the reason why I'm not is because we haven't finished calculating real estate returns through 9:30. But what I want to tell you is that real estate is not a one-year investment. It's a long-term investment. So as I think about the modern real estate investment world, which I consider to have started really in the immediate aftermath of the dot-com bubble burst, I see that real estate, and private real estate in particular, which is NCREIF, has averaged a return on an unlevered basis of 9%. That is higher than every other asset class except for REITs. Now, the problem with REITs is that they're highly volatile, which is evidenced by the standard deviation that you see under the average REIT return of 10% being 22%. Volatility around private real estate, meanwhile, is 9.5%. So in other words, what's the better risk-adjusted return? What you want is to achieve a high average return with low volatility. And the measure of that is the Sharpe ratio, which tells you what is the extra return I'm able to generate as a function of the volatility that I take to try to earn that alpha. And what you want is a really high score, and private real estate has the highest score. It's, if you take the risk-free rate of 4.1%, that's the average return of treasuries, and you compare it to 9%, you've got about 5 percentage points of extra return, and you divide that into the standard deviation, and you've got 51.9. That's a fantastic score. So as a result of people recognizing the long-term growth that private real estate affords to investors and the low volatility, people are allocating more money into real estate. So in 2005, the average allocation amongst an institutional investor was 5.2%, and that's nearly doubled this year to a target of 10.3%. Fortunately or unfortunately, depending on where you sit in the industry, that 10.3% is just a target, and the ability of these investors to fund that to that target has yielded a 140 basis point balance of dry capital. We'll talk a little bit more about that later, but in essence, it means that there's a lot of capital that is increasingly interested in deploying into real estate, but it's having a hard time finding all the opportunities to place it. So that's just a massive tailwind that's helped our industry. The number one question that I get about the forward look on the real estate market is, Jimmy, what's going to happen with interest rates, and is that going to impact transaction volumes and asset prices? What is the Fed's monetary policy going to do to our industry? I would tell you that the Fed is not really on my radar screen just yet. When the Federal Reserve's Open Market Committee increases their target Fed funds rate by 300 to 400 basis points over a consistent period of time, that usually is an indicator that our economy is getting really, really hot and is at risk of overheating. Right now, the Federal Reserve Open Market Committee has only increased its target Fed funds rate by 100 basis points. It's highly probable that they're going to hike again in December. That would only be another 25 basis points at a maximum. So I'm not terribly concerned that the FOMC is putting us into recession. Furthermore, there's a precedent for transaction volumes rising in a rising interest rate environment, which took place in 2004, 2005, 2006, 2007, 2012, 2013, 2014. Interest rates and transaction volumes are not correlated. And the thought process is, when interest rates are rising, it's usually because the economy is expanding. And when the economy is expanding, that benefits real estate. And when real estate has better property fundamentals, we see more investment capital flow into that asset class. On the contrary, when we see interest rates fall, it's usually because people are seeking security because there's something amiss in the national or global economy, as was the case in 2008, 2009, 2010. Right? And that doesn't necessarily convey worry in the marketplace, or excuse me, that doesn't necessarily mean that a fall in interest rates should beget a rise in transaction volumes. So first half of the year, transactions were down about 10%. I think it'll be the same when we get third quarter data, which I think is coming this evening from Real Capital Analytics, which is who we use for this data. And what we saw in the second quarter was a sharp turnaround in large-scale transactions. What I mean by that is portfolios and corporate M&A amongst real estate companies. We saw a 15% increase in that type of trade in the second quarter alone. And that's really important because if you want to see headline transaction volume growth get anywhere near what it was in 2007, when half the market was portfolio and entity level trades, we really need some more activity in that part of the market. So there are a lot of deals that have been announced in corporate M&A, and I would expect that as those deals continue to close in the fourth quarter and into the first quarter of 2018, we'll see that part of the market continue to pop. So not everything is rosy in equity. The non-listed REITs are having a hard time raising as much capital as they did earlier in the cycle, and the cause for that is shift the way that they have to report their fee structure to the investors that are buying their shares. As you can see, the amount of money that the non-listed REIT industry has been able to raise each month is really bumping along an all-time low. And the reason why it shifted to a static rate from just a continuous decline for a number of years was because Blackstone came out with a new non-listed REIT product that has a very low expense load of around 3%. And they've got better transparency in the way that they calculate the net asset value of the assets that the REIT holds. As a result of that change in structure, they're raising about $5.5 million a day, which is more than all of the other non-listed REITs raising capital on this page combined. So there's a bright spot in a troubled part of our industry, and what we expect is to see more REIT management groups come up with products that mirror what we call the B REIT, the Blackstone REIT. The public REIT market, sorry, we're having trouble, I think, with this slide. The listed REIT market is about a $900 billion equity cohort. So that is the largest organized concentration of equity in the real estate market that we can identify. In 2015 and 2016, the value of REIT shares suggested that the company, the REIT company, was trading for a value that was below the value of the assets that that company held. In other words, if a REIT had $1 billion of assets on their balance sheet, maybe they were trading for $900 million. We call that a discount to NAV, and in that environment, they don't want to use their currency, their shares, in a transaction. We have finally started to see these REITs trade closer to equilibrium and even at a premium in certain property types. As a result of that, we're seeing that big pop in portfolio and entity level trades that I mentioned earlier. This is a list of all the REIT M&A that's been announced very recently, and a lot of this is still remains to be closed, so we'll see that a lot of this happen in the fourth quarter. And while the first 5 or 6 bullet points here are all REIT transactions, the last one doesn't involve two REITs, but is very much a play into the real estate market, and that is Amazon.com's acquisition of Whole Foods Market, which was approved by the shareholders of Whole Foods and the FTC a number of weeks ago. So we're starting to see real estate transactions take place outside the real estate industry. The other big sources of capital that are strengths for the U.S. real estate market, in Dallas in particular, are insurance companies and sovereign wealth funds. As I mentioned earlier, institutions are underweight relative to their target for real estate, and the biggest discrepancies are insurance companies, which have a target of about 9%, but are only 6% funded, and sovereign wealth funds who have a target of about 10.5% and are only about 8% funded. What this means is that these very significant sources of capital are looking to deploy into real estate, and they're having a hard time finding the opportunities. Now, the reasons why they're coming here are several, and I list them on the page. What they're really looking for is income sustainability and diversification out of their country and out of their domestic currency if they're not pegged to the dollar. A great example of this is the Middle East, where I spent some time about a year ago. And while they have very innovative design and construction, for example, this building on the left-hand side in Doha, Qatar, has panes that open and shut depending on where the position of the sun is relative to the building to help with cooling. And on the right, you have a building in Manama, Bahrain, which is a really innovative architecture, but is located in what I can only call an emerging neighborhood that doesn't have a lot of amenities. While they are trying to get their money out of natural resources and into real estate, what they're realizing is they should do that in country to some extent, but really try to push that investment into the U.S. So we see them bringing their scale and their capability and their technology into the U.S. And what we have tried to do at HFF is go overseas and meet with these groups and tell them how to invest in the U.S. And this is 2 years ago in September that some colleagues and I were in a few different cities in China advising them on how to invest in apartments, which as a business don't really exist in China. Certainly they build high-rise residential properties, but there's no Trammell Crow Residential or Mill Creek Residential in China that builds buildings and operates them as for-lease properties. We go over there, we advise them how to invest their capital, and over a number of years they start to come over here, and I think we've done 37 joint ventures with Chinese capital with domestic developers, and a number of those transactions are there in Dallas. So what we're starting to see is them really embrace the market here and not just on a temporary basis. And their ability to come into markets like Dallas is thanks to direct international routes that American provides to Beijing, Hong Kong, and Shanghai. This is one of American's newest Boeing 777-300ERs, which is an extended range plane with all the nice amenities, and they're providing direct routes into China. Qantas Airlines is also providing direct service to Sydney from Dallas, and I think that's the third longest direct international flight in the Western Hemisphere. So you have excellent connectivity to foreign capital, which is why you also have in Dallas-Fort Worth one of the largest rates of foreign capital investment in the Dallas market. This blue dot here is telling you the amount of foreign capital that was invested in 2001. The orange dot is telling you what was invested in 2016. So Dallas is up there with the big boys and girls in terms of the amount of foreign capital that's coming into the market. You're ahead of DC, you're ahead of Atlanta, you're ahead of Seattle, you're ahead of Miami and Boston, which are seen as gateway markets. So I don't really think of Dallas-Fort Worth as a secondary market anymore. I think that you absolutely are, based on your economic performance and your real estate market performance, right up there with all these other markets. The largest single country investor over the past several years has been South Korea, as I mentioned earlier. There's a lot of talk about China, and I'm really going to skip through this quickly because we need to cover debt. But I don't really see a problem with Chinese capital investing in the U.S. real estate market. Certainly foreign capital flows have declined alongside transaction volumes, and part of that is not only have transaction volumes declined 10% on the first 6 months of this year, but foreign capital is also moving into development. They're also moving into debt strategies, and that's not captured within transaction volumes of stabilized assets. Furthermore, China is not the number one foreign investor in the U.S. real estate market this year. They're just number 2, and they're still investing more than Singapore and Germany and Japan, which are countries that have very significant amounts of capital. I'm going to skip through the China and Trump conversation that I would have if I had a little bit more time, and tell you that on the left-hand side, I'm showing you all the unique Chinese-based companies that invested in the U.S. real estate market in 2016. And on the right-hand side, you have the unique companies that invested only in the first 6 months. And I don't see a real drop-off in capital coming from China. So don't believe the hype. The open-end and closed-end fund space is extremely healthy. They're awash in capital. They've doubled their AUM, more than doubled their AUM since 2007, which was their previous peak. And currently they hold about $140 billion worth of dry powder waiting to invest in real estate. As a result of that, the ability of funds who are in the market raising capital from investors has dropped. The headlines that you might read say CalPERS cuts their allocation of capital to real estate by 50%. And that's a really negative headline that grabs your attention, and it makes you worry about the state of our industry. But why would CalPERS give a bunch of money to an investment manager when that investment manager is still trying to spend money that CalPERS has already committed to them? So it's not necessarily a negative story. It's a story wherein the investment managers are being very methodical and they're awash in capital, but they're not desperate, which is what I told you at the top of the presentation. All in all, we have a very diverse equity market with a wide range of participants representing lots of different investor types. On the debt side, the story is not quite as complicated. In an environment where people are not trading their assets quite as often, they're choosing to refinance. So while transaction markets were down 10% in the first half of the year, the debt market's up 15%. And virtually every lender type is up in originations, with the exception of banks. And they're down about 8%, but I expect when the third quarter numbers are released that they'll look more like flat and that the market will still be up in the mid-teens. Construction lending is extremely tight, and as a result of that, we've seen a drop-off in land sales And as I mentioned earlier, a falling off of the development pipeline this late in the cycle is beneficial to property fundamentals. Like the equity market, we see the debt market as being highly diverse, and where CMBS has lost market share since 2014, every other lender type has really picked up the slack. So we move into geographic diversion, and that's where Dallas really shines. In October of 16, so this time last year, Dallas-Fort Worth was named the #2 market most favored for investment and development by ULI and PwC. And a big reason for that is your economic performance. In the year into June, your employment base has grown by 3.3%. Now that rate of growth is starting to moderate, and that's okay. Your unemployment rate is really, really low. Your availability of unemployed labor participants is really, really low. So we want to see your labor participation rate continue to climb, and it is. But the reason why people want to invest in markets like Dallas is because you're growing, right? Why would you want to invest in a market that's not growing? Additionally, you also provide cap rates that are more attractive than you have in markets like LA and Chicago and Washington, D.C. and New York. People want high growth and high yield. As a result of that combination, your transaction volumes grew 20% in the first half of the year. And the reason why I've highlighted Dallas in orange is because your $9.2 billion of transaction volume in the first 6 months of 2017 was a record for the first 6 months in any year. Same for Charlotte. So what you see here are markets like Los Angeles, Manhattan, Chicago, Seattle, the New York City boroughs, Miami. They're all down double digits. You are up double digits, and that's really great. Moving into asset pricing before I wrap it up, I mentioned earlier I'm not concerned about development. We see the development pipeline remaining very, very low relative to historical norms going forward. There was a lot of chatter a number of years ago about the, quote, wave of maturities that were peaking in 2017. We are moving through virtually all of these loan maturities with no significant spike in delinquency. We see transaction volumes increasing because as AUM amongst the funds has doubled over the past 10 years, the truth is that 89% of that AUM increase has either already traded or is in the queue to trade because these funds hold for 7 years or less. In terms of cap rates nominally feel like what they were in 2007, but the spread that they represent to the risk-free rate is much wider than it was in 2007. But people are concerned about cap rates because when cap rates go up, you have to increase your NOI to keep your value constant. For example, if I buy a property at a 5 cap, and a number of years later I sell it at a 6 cap, I need to grow NOI 20% to hold my value constant. So in a rising interest rate environment, which we are thought to be in right now, people are very, very concerned about how to grow NOI. And how do you grow NOI? By investing in a market that has proven growth, like Dallas-Fort Worth. Really to wrap it up, I want to tell you that this is something that everybody needs to pay attention to, and that is the rate of employment growth at a national level. While Dallas has been really successful on its own, it depends very heavily on the health of the broader country. Last month, we had a hiccup in our employment growth as a country. We lost 33,000 jobs. A lot of economists think that that's because of all the noise that was created in the marketplace by Hurricane Harvey, Tropical Storm Harvey, Hurricane Irma, etc. So I expect that number to be revised upward at the end of the month when that number is revised. And I would expect that October employment growth will be positive also. But when we start to see employment growth moderate, we see price or asset values moderate for real estate as well. And that relationship is virtually perfect. So as I think about investing late cycle in real estate, I absolutely want to be in a market that has a tight labor pool, a labor pool that's earning more wages, that is exhibiting population growth and household formation, that has a diverse base of corporations that already exist in the marketplace and are moving into the marketplace. All of these things Dallas-Fort Worth exhibits. And in an environment where new additions through construction are governed by a difficult operating environment for developers vis-a-vis low availability of construction capital, I have to feel really good about leveraging Dallas-Fort Worth as a place for me to achieve alpha above national averages and to take a bit of a defensive posture in my portfolio. So with that, finishes my comments, and if there are any questions, I'm happy to take them.
Well, Jimmy, thank you so much again for taking the time to share with us. As usual, so much I can barely take notes on the information you've provided. We do have some questions from the crowd, starting with a question about how much room we have to run in the cycle, assuming we're near the end or at a point of moderation. How would you advise investor clients to shift focus or modify strategy?
Well, that's a great question, and it's aside from how are interest rates going to impact transaction volumes and asset values, that's the other question I get is, if you believe that we're late in the cycle, how do you shift your investment strategy? A lot of people look at an inverted yield curve to tell them when a recession is coming, and usually by the time we all see an inverted yield curve, it's too late to manage your portfolio. So if you think that you are seeing something that no one else sees and you see weakness on the horizon, what I would advise you to do is remember what happens when recessions come around. Usually interest rates fall, which doesn't really require you to drive NOI unless cap rates expand because people are worried about buying real estate. So you have to ask yourself, what conditions do you expect in an environment where we start to see some recessionary pressure? My personal, this is not an HFF official statement. My personal goal in an environment where I think a recession can come, say, in the next 12 to 18 months, would be to invest in long duration income that has very, very high credit quality. And I understand that in a recession, when interest rates are falling, bonds gain value. And core assets in real estate trade a lot like bonds because they're treated like fixed income instruments. So if I were an investor looking at Dallas, I'd say, wow, Mirai did a really good job of buying the new State Farm campus because State Farm is great credit and it's a long-term lease in a new building in a great market. Because that income stream can withstand the capital appreciation volatility that comes during a recession. Now, there's a problem and a reality if you're an investment manager and all you do is invest in income duration because typically that's a lower yield. If you thought you had enough time to start a development opportunity that represented, again, a development opportunity that was fairly core-to-core plus in nature. So you're building to a core-to-core plus exit. That's going to give you a little bit of extra return to mix into your portfolio so that you can hike up your portfolio returns relative to a benchmark that you're judged against or against your peers. Because if all you do is invest in core properties, it's going to drag down your yields. So I would do a mix, and I couldn't tell you what percentage mix it is because I don't know enough about the person that's asking the question and the firm that they work for, but I would try to blend that core investment strategy, long-term income duration, with very, very choosy development opportunities that need 3 to 5 years to come to fruition so that you can withstand your building through the recession and coming out hopefully with some higher yields.
Okay, I think we have just one more question, and that is about Houston. Jimmy, I know that you're based there typically, and you spoke a little bit about the immediate impact of the recent hurricanes, but do you have any inklings yet of mid to longer term impacts, particularly on Dallas, of what's been going on in the Houston market?
Frankly, I don't think there will be that much impact on Dallas. Much like the questions about the fall in the price of oil from a couple of years ago, Dallas is seen externally very much as a part of the Texas economy. And for the people that don't know Dallas very well, they have visions of cowboy hats and gold Rolexes and oil derricks, etc. And it's just not true. Where Dallas has exposure to energy has more to do with natural gas and power, not necessarily oil. And certainly there are families and companies in Dallas that are well known from their wealth that's been created with oil, but the biggest employers and the biggest drivers of population growth and household formation is diversified corporate interest. So the same goes with Harvey. I don't think you're going to have a big influx of, quote, refugees from Houston. in the Gulf Coast into the Dallas area. I don't think it's really going to help your residential market that much. I think you may see some corporations who are thinking about relocating to the Texas area, and they think about where they want to put their people, and that may tangentially help. But I can't think of any specific corporations that are thinking that way. So as it relates to Dallas, I just don't see that much of an impact up or down. There is one area where I think it could impact Dallas, and that's with construction costs. And so let me tie that into Houston. Houston had an apartment market that was really feeling the impact of too much development and not enough economic growth. And when we had these very, very large neighborhoods that were highly concentrated in different parts of the city, inundated with water, we saw people need temporary housing. So that has provided a temporary benefit to the apartment market so far, and I say temporary because we're not sure what lasting impact the boost in apartment occupancy is going to have on the apartment market. Landlords I'm talking about are very sensitive about hiking rental rates for apartments because that is a form of price gouging. So as an alternative to hiking rents, what they've been able to do is burn off concessions. So where a landlord might have been offering 2 to 3 months free on a 13-year lease, they're signing up a shorter-term lease with a tenant who's lost their home or is out of their home and needs an apartment. They're doing a 6 to 9 month lease with no concessions. So there's no economic vacancy at so many of these properties that just weeks before the storm we're really suffering from that. So that's the biggest outsized impact we've seen. There hasn't been any shift in logistical throughput through the industrial space. There hasn't been any real change in retail spending, other than to say that car sales certainly have seen a bump with how many cars were flooded. We've seen a lot of construction materials get moved through the city. That obviously helps retail and industrial. We have a few tenants that are looking for temporary space until they get their home bases back online. But really the biggest shift that we've seen has been in the residential side. And the coverage of the storm damage was emotional. It was astounding. But I think it probably overstated just how broad the damage was across the city. So if anybody has questions about where exactly all the flooding was, we will inundate you with the coverage of where the city was inundated.
Okay, well, we are about out of time. Jimmy, thank you so much again for your time. This has been super informative, and we appreciate it. I've already gotten questions about whether or not the slides are going to be available. We will have the slides available upon request, and the video will be available on the website, our Trek Wire blog, within 72 hours. So thanks again for everybody who was able to join us today, and thank you again to Jimmy. Everyone enjoy your day.
My pleasure. Thanks so much.